Every dollar you borrow costs more than a dollar to return. That gap between what you borrowed and what you owe is not accidental. It was designed, refined over centuries, and built into every loan product you use today. The question is not whether interest exists. The question is, who does it work for? Most people think interest is a fair fee for borrowing money. You use someone else's money, you pay a small fee, everyone wins. That framing is incomplete, and the incomplete version costs you enormously. Here is the reality. Interest is not a flat fee. It is a percentage applied to a shrinking or growing balance every single period. When you save, that compounding works slowly in your favor. When you borrow, that same compounding works aggressively against you. And the system is structured so that most people borrow far more than they save. That is not a coincidence. That is the architecture. Let's walk through exactly how this works, starting with a simple loan. You borrow $10,000 at 20% annual interest, a common credit card rate. In year one, you owe $2,000 in interest alone before touching the principal. Now here is where the mechanism becomes a trap. Most minimum payments barely cover the interest. Say your minimum payment is $200 per month. At 20% interest on $10,000, roughly $167 of that $200 is interest. You are paying $200 to reduce your balance by $33. That means it takes over 25 years to pay off a $10,000 credit card balance, paying only the minimum. And the total amount repaid? Roughly $26,000 on a $10,000 loan. The bank receives $16,000 in profit from one decision you made about carrying a balance. Now multiply that across millions of customers and across mortgages, auto loans, student debt. This is not one loan, this is a system. Now let's zoom out and look at what this does over a lifetime. The average American carries $6,000 in credit card debt continuously. At 20% APR, that is $1,200 per year in interest payments, every year. Over 30 years, that is $36,000 paid in interest on the same $6,000. But the hidden cost is not just the money, it is the opportunity. If that same $1,200 per year had been invested at an 8% average return, it would have grown to over $147,000 in 30 years. You did not just lose $36,000. You lost $147,000 in future wealth. That is the real cost of carrying interest, measured not in what you paid, but in what you never built. Now add a mortgage. The average 30-year mortgage at 7% on a $300,000 home costs $418,000 in total repayments. You paid for the house, then you paid for it again, almost halfway. Add student loans, add a car payment, add store financing. The average household pays over $8,000 per year in interest across all debt categories. That is money leaving every month, producing nothing for you, producing everything for lenders. Here is the core truth. Interest, as a system, transfers wealth from people who spend first and earn later to people who lend first and collect always. Borrowers live in the present. Lenders profit from the future. The system does not require malice. It only requires that you carry a balance. And the financial products most aggressively marketed to lower-income households, payday loans, store credit, subprime cards, carry the highest rates. The structure of access mirrors the structure of extraction. Those with less pay more to borrow the same amount. This is not a bug. This is how the margin is built. Understanding this does not require anger. It requires precision. Interest works in one direction when you carry it, and another direction when you hold it. The goal is to spend as little time as possible on the wrong side of that arrow. That means treating debt not as a tool of convenience, but as a cost with a measurable rate of return. Every balance you carry is an investment in someone else's income. Every balance you eliminate is a guaranteed return equal to that interest rate. No investment product offers a guaranteed 20% return. Paying off high-interest debt does. That is not motivation. That is arithmetic.